You know, for decades, a lot of public servants have had their Social Security benefits cut because of a couple of really controversial rules. Well, guess what? A huge new law just got rid of them, and that could mean hundreds of extra dollars in your monthly check. So let's break down what the repeal of WEP and GPO really means for your retirement.
So if you're a retired teacher, a federal worker, or maybe a state employee, you might have noticed a very welcome change in your Social Security check lately. If that's you, then this explainer is definitely for you. Because all that extra income, it comes with some really important new things to think about.
Here's what we're going to cover. First, we'll look at those old windfall rules that just got tossed out. Then, we'll talk about the new law, what it actually means for your income, a surprising tax trap you absolutely need to know about, and finally, what you can do to manage your finances from here on out.
All right, first up, the old rules. For years and years, two things called the Windfall Elimination Provision and the Government Pension Offset, or, WEP and GPO for short, they were responsible for cutting Social Security benefits for millions of public sector retirees.
Okay, so the first rule was the WEP. This one applied to you if you had a pension from a job where you didn't pay Social Security taxes. Think, for example, the old civil service retirement system. But you also earn Social Security from other jobs, maybe a second career. The idea, at least from Congress, was to prevent what they called a windfall from a benefit formula that was really designed for long-term, low-wage workers.
And wow, this chart right here is a perfect visual of how WEP actually worked. Just look at that first row. The standard formula gives you credit for 90% of your first chunk of earnings. But under WEP, that could get slashed all the way down to 40%. The other part stayed the same, but you can see how it just directly took a huge bite out of the most important part of the calculation.
Now, the second rule was the GPO. This one was a little different. It didn't mess with your own retirement benefit. Instead, it reduced, or in a lot of cases, completely wiped out any spousal or survivor benefits you might have been eligible for through your husband or wife's Social Security record.
And the math on this was just brutal. Let's say you had a government pension of $55,000. The GPO formula took 2/3 of that, so about $36,850, and subtracted that from whatever your spousal benefit would have been. So if that benefit was, say, $36,000, poof, it was gone. You got nothing.
But after so many years of debate, that whole reality has finally changed. And that brings us to Section 2, the solution, a landmark new law called the Social Security Fairness Act.
And this right here is the big news. The Social Security Fairness Act was signed into law, and it did one really simple, really powerful thing. It completely got rid of both the Windfall Elimination Provision and the Government Pension Offset. They're gone. They're no longer in effect. So how did this all roll out? Well, the law was signed in January of 2025, but, and this is a really crucial detail, it was made retroactive all the way back to January 2024. That meant retirees were actually owed back pay for an entire year. And those bigger monthly payments and the lump sum back payments, they started hitting bank accounts all through 2025.
Which brings us to, let's be honest, the best part of this story, your new income boost. Let's really look at what these changes mean for your wallet.
For all those folks who were hit by WEP, the change was immediate and it was big. On average, retirees saw their monthly Social Security checks go up by about $300 to $500. I mean, for somebody on a fixed income, that is a total game changer. And then there was the back pay. Because the law was retroactive, a lot of retirees got a pretty large one-time lump sum payment sometime in 2025. For some people, this was $10,000 or even more, just covering the benefits they missed out on during 2024.
The impact of getting rid of the GPO was just as incredible. In one case we saw, a retiree suddenly became eligible for a new spousal benefit of over $1,700 a month. That's more than $21,000 in extra, totally unexpected income every single year.
Okay, now listen up, because this is a really, really crucial point. If you were affected by WEP, the correction to your benefit was probably automatic. But for GPO, that's not always the case. I mean, think about it. Social Security can't pay you a spousal or survivor benefit if you've never even applied for one. So if you think you might be eligible now, you have to get in touch with them.
Okay, so a higher income is fantastic news, right? But it's not the end of the story. This extra cash can actually trigger some new financial challenges, creating what some people are calling an unintended tax trap.
So here's the new reality we're all in. The good news is obvious, a permanent, meaningful boost to your retirement income. That's fantastic.
But the challenge is that this higher income can easily push you into higher tax brackets and trigger higher premiums for Medicare.
Okay, let's talk about Medicare. Your Part B premiums are subject to something called IMRAA. And to put it simply, the more you make, the more you pay. But here's the really important part, the 2-year look-back. This means the income that you reported on your 2025 tax return, including that big lump sum back payment, that's what's going to be used to set your Medicare premiums in 2027.
And it's not just about Medicare. A higher adjusted gross income can have a ripple effect across your entire financial life. It could reduce or even completely wipe out your eligibility for all sorts of things, tax credits, deductions, and other benefits that you might have been counting on for years.
So, what do you do about all this? Let's move into our final section and figure out how to navigate this new landscape, because with these changes, having a forward-looking plan is more important than ever.
So, here's a simple action plan. First, if you haven't already, apply for any GPO-related benefits you think you might be owed now. Second, take a hard look at your total 2025 income so you can get ahead of those 2027 Medicare premium changes. Third, don't wait until next spring. Prepare a tax projection for this year, right now, to see where you stand. And finally, you might want to consider setting up automatic tax withholding from your pension or Social Security to avoid a nasty surprise bill.
You know, there's a great saying that just sums all this up perfectly. You don't have a financial plan if you don't have a tax plan. Just filing a return in April, that's like looking in the rearview mirror. Real planning is about looking ahead. It's about making smart decisions all year long to manage your taxes. And now, with this new income, it's an absolutely essential part of your retirement plan.
And of course, as always, please remember that this explainer is for educational purposes only. It should not be considered personalized financial advice. You should always consult with a qualified professional about your own specific situation.